John, Woolworths, we've just seen the share price jump up by more than $1 on suggestions that KKR might be looking to have a bite out of it. Do you give much credence to those suggestions?
Well, anything's possible at the current price. And to put it in historical context, I think what people are forgetting is that when Coles was taken over by Wesfarmers, the acquisition price was $22 billion, and that was in 2007, and the retail market's increased by about 25–30%.
What sort of capitalisation would have been for?
Well, Woolies prior to today went down to about $32 billion. So a lazy $10 billion more at yesterday's market price for a business which is 3 times profitable than what Coles was when Wesfarmers bought it. So I think what happened is that we've got a market which is full of arbitrage, up and down. Yeah. I think the stock was over 100 million shares shorted as of last night.
So sorry, we're in a funny position that you're saying it might actually make sense to make a bid for Woolworths, but yet there's a lot of weird stuff going on in the market.
The market's being arbitraged down, and the statements coming out of brokers and hedge funds and people who seem to know nothing about retail telling you that the end is nigh for Woolworths. I think what they're doing is creating a market price where a few things may happen. Either Woolworths will be attractive to some foreign entity, whether it's a big retailer, a strategic investor or a private equity group, or Woolies itself may well consider a buyback because the shares are being offered at fairly low levels based on growth of company and the current market price. But I reiterate, Wesfarmers paid $22 billion for Coles, and if people go back, that was about 20 times EBIT.
Yeah.
Okay. Now I don't want to say Woolies is worth 20 times EBIT, but if you actually believe that a company can come in and help Woolworths reorganise itself, restructure itself, well then clearly the current price is very, very cheap for a major retail company.
But also, on a related question, isn't there a bit of a risk for retail investors in being bobbed around in this market, this share market, where it's essentially travelling sideways, and you've got a lot more shorting, you've got a lot more room. I mean, I'll go with arbitrage. I've certainly followed things in the smaller end of the market. It's getting quite dangerous.
Well, the market's going nowhere, as you said, so it hasn't gone anywhere in 8 years, and I was just looking at the market, it's only 2% above where it was in October 2013. So we're 18 months going sideways now after a rally in 2012-13.
With some good dividends, admittedly.
Good dividends. The Australian market is just a dividend market, and then I guess Woolworths fits the bill. But the other problem with Australia is, and it is a funny problem, we're raising way too much money for superannuation accounts. Now people might say that's a crazy statement, but
it's too much to be accommodated in the local market.
The Australian market can't accommodate it. Now what that leads to is derivative transactions. Major funds, there's no way they can invest their proper allocation to Australian equities. So they will do over-the-counters and derivatives and futures. And when you see the market like the Australian market has behaved this June, like it did in June 2014, which has done 3 or 4 times in the last 5 or 6 years, where the market inexplicably goes up or down.
Is this end of financial year adjusting and tweaking?
It is. I mean, some people claim there's mandates being lost. Well, if the people who control mandates like to see fund managers wipe off 3 or 4% of the value of their portfolios to turn it over, then they're incompetent, okay? And there's a level of incompetency in this market which is becoming distressing, but it does say to retail investors, forget about the short term, absolutely forget about it. Start investing for long term. These short term movements are an opportunity. But don't think this is about making money in 3 months or 6 months or a year. It's probably a 3 to 5 year gig. And we're going to go through a couple of things in Australia. We're going through a slow growth period. We're going to have a massive devaluation at some point in the currency, because without that, the economy is going to go into recession.
So we'll have to have it.
Yeah.
John, thank you very much.
Thanks.